Hey everyone, and welcome to This Explainer. I am absolutely thrilled you're joining me today because we're going to do something really exciting. As an investment analyst, I am constantly seeing companies throw around massive numbers. They're promising huge yields and projecting endless growth. But how do you actually separate the signal from the noise? Well, you put them through what I like to call the gauntlet. Today, we're taking SFL Corporation, which is a major player in maritime and offshore assets, and we're going to run its latest financial data through the legendary investing frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, alongside some modern discounted cash flow models. We are going to find out exactly what the financial titans would think of this stock right now.
Okay, let's just dive right into our roadmap. We'll kick things off with a company snapshot. Then we'll run SFL through the Buffett lens, the Peter Lynch lens, and the Graham lens. After that, we'll hit the DCF and quants, and finally, we'll wrap it all up with our final verdict.
Section 1. Company Snapshot for SFL Corporation. So, who exactly are we putting under the microscope today? SFL Corporation. They trade on the New York Stock Exchange under the ticker SFL, and the stock is currently sitting at $10.81. Now, they are a massive international ship-owning and chartering company. We're talking everything from crude oil tankers to offshore drilling rigs. And this number right here, 89, is probably the very first thing that jumps out at anyone reviewing their data. The company just declared its 89th consecutive quarterly dividend, which they recently bumped up to 22 cents per share. If we annualize that 88-cent payout, it gives us a massive implied dividend yield of 8.1%. And let's be honest, in a world that is hungry for yield, that is a serious, serious magnet for investors. But SFL's foundation isn't just cash, right? They are operating 57 hard maritime assets globally. And more importantly, they've secured a massive $3.7 billion fixed revenue backlog. That backlog is literally the engine supporting that 8.1% yield we just talked about. It provides this fantastic baseline visibility that management relies heavily on to keep things running smoothly.
Section 2. The Warren Buffett lens. It's time to look at moats versus debt.
When Warren Buffett looks at a business, he demands a wide economic moat, consistent earnings, and totally predictable owner earnings, which basically means the cash flow left over after required capital expenditures. So running SFL through his checklist gives us a somewhat mixed scorecard. Does it have a moat? Yes, absolutely. That $3.7 billion long-term charter backlog is a massive competitive buffer. But consistent earnings? No. SFL just swung from a nearly $32 million loss in Q1 of 2025 to a $26.1 million profit in Q1 of 2026, and Buffett really hates earnings volatility. Furthermore, their required capital expenditures are completely immense right now, which severely depresses their true owner earnings. Their return on equity is moderate, sitting around 10.7%, but honestly, the real sticking point here is the debt.
Yeah, the debt load is daunting. You've got $723 million in short-term interest-bearing debt and almost $1.8 billion in long-term debt. That is $2.52 billion in total borrowings for a company with a market cap of roughly $1.46 billion. It's enough leverage to make any old-school value investor need a really stiff drink. Buffett famously avoids highly leveraged companies because it severely restricts flexibility, and it eats right into those precious owner earnings through interest expenses. I mean, their interest expenses were over $38 million just in this quarter alone. So what's the Buffett verdict? It's likely a pass. While that $3.7 billion backlog is an undeniable moat, the Oracle of Omaha demands pristine balance sheets and predictable earnings. The heavy debt leverage and the purely cyclical nature of the shipping industry would almost certainly keep Buffett observing from the shore rather than jumping on board.
Moving on to Section 3, the Peter Lynch lens, let's dig into yield and categorization. Now, Peter Lynch approaches things a bit differently. He loves to categorize stocks into distinct stories. Based on the raw data, SFL is best described as a high-yield cyclical with turnaround characteristics. It's cyclical because the maritime shipping and offshore drilling industries are notoriously boom and bust, heavily dependent on global macroeconomics. But right now, it's also a turnaround story. Their operating income actually surged to $56.4 million this quarter. This was supported by lower costs and a vessel sale, completely pulling them out of last year's losses. Running through Lynch's other criteria gives us some genuinely enticing numbers. That 8.1% dividend yield, excellent. Annualizing their Q1 basic earnings gives us 80 cents per share, which means SFL is trading at a PE ratio of roughly 13.5 times. Now, Lynch famously focuses on the PEG ratio, which is price to earnings divided by growth.
If we assume even a modest low single-digit growth in this mature industry, say maybe 2 to 3%, the PEG ratio pushes well above 1, possibly into the 4 or 5 range. So that isn't exactly deep value by Lynch's strict growth standards, but that massive 8.1% yield helps offset it significantly in the eyes of income investors. Also, he absolutely loves share buybacks, and SFL has extended its repurchase program out to June 2028. However, just like with Buffett, those heavy refinancing needs on that $2.5 billion debt present a really high risk.
Therefore, the Peter Lynch verdict is a cautious hold. The yield and the buyback program are strong signals that management truly believes in the company. However, the sheer scale of the leverage, combined with SFL's massive $848 million commitments for new builds container vessels, means you absolutely cannot just buy the stock and forget about it. A Lynch investor would probably hold it, but monitor that balance sheet like a hawk.
Section 4, the Benjamin Graham lens. Time for some deep value math.
Benjamin Graham isn't interested in stories or wide moats at all. He relies entirely on cold, hard math and the margin of safety. To find that margin, we use Graham's legendary intrinsic value formula. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share. Basically, Graham believed a stock shouldn't be priced at more than 15 times earnings or 1.5 times book value. You multiply 15 by 1.5 and you get that magic constant of 22.5.
Let's actually plug the numbers in and see how this builds using the exact figures from SFL's latest SEC filing. We're going to use our annualized EPS of 80 cents. For book value per share, we take SFL's total stockholders' equity, which is $964.8 million, and divide it by their roughly 133 million outstanding shares. That gives us about $7.25. Okay, so 22.5 times 0.80 equals 18. 18 times 7.25 equals 130.5. Take the square root of 130.5, and we arrive at a Graham intrinsic value of $11.42.
So how does that actually compare to our current price of $10.81? It gives us a margin of safety of exactly 5.3%. This is the buffer between what the hard math says the company is truly worth and what the market is currently pricing it at.
The Graham verdict here is a cautious buy. Mathematically speaking, SFL is trading at a discount to its hard intrinsic value, and that technically triggers a buy signal in Graham's framework. However, it's worth noting that the strictest Graham disciples usually look for a much wider margin of safety, often around 33%, just to protect against exactly the kind of debt and cyclicality risks that SFL inherently carries.
Section 5, DCF and additional valuation models.
Now, stepping into the modern era, building a base case discounted cash flow model for a complex company like SFL requires some really careful assumptions. Because of that $2.5 billion in debt, the weighted average cost of capital, or WACC, which we use as the discount rate, has to be modeled relatively high. We're talking between 8 and 10%. Also, the shipping industry is incredibly mature, so the terminal growth rate is modeled quite low, right between 0 and 2%. When we finally run these free cash flow projections, the resulting fair value range is incredibly wide, landing anywhere from $9.50 all the way up to $12.50. It is just highly sensitive to interest rates and whatever SFL's refinancing costs end up being over the next 12 months. But if we compare other quantitative models against our 10.81 current price, we start to see a really interesting trend. Because SFL is such a remarkably strong dividend payer, applying a dividend discount model values the stock around $11. Simply Wall Street's algorithmic fair value actually places it slightly higher at $11.72, and Wall Street analysts tracked by Quiver Quantitative have a median price target of $13, which suggests over 20% upside. So across the board, the quants definitely see the stock as undervalued.
Section 6, synthesis and final recommendation. So how do we actually blend all these competing insights to figure out what you should do? Well, the fundamental tension of SFL Corporation is perfectly captured right here. On one hand, you have these massive income-generating global assets churning out an 8.1% yield, fully backed by a $3.7 billion contract backlog. It's a beautiful thing. But on the other hand, you have daunting capital expenditures. I mean, $848 million just for new dual-fuel container vessels. Plus, you have the immense pressure of refinancing $2.5 billion in debt right in the middle of a high interest rate environment.
Looking at our final scorecard, notice the clear, literal divide here. The mathematical models, from Benjamin Graham's intrinsic value formula to the DCF models, Simply Wall Street and Quiver's analyst consensus, they all point to buy. Every single one calculates a fair value higher than the current 10.81 share price. But the qualitative risk-averse framework, specifically Buffett and Lynch, tell a totally different story. They look right past that amazing yield and fixate entirely on the debt and cyclicality, which results in a hard pass and a cautious hold.
And that brings us to the ultimate provocative question. SFL is mathematically undervalued and rewards you with a fantastic 8.1% yield to just sit back and wait for the market to catch up. But it carries a debt load that would literally make Warren Buffett walk out of the room. As you weigh the insights from this explainer, whose philosophy actually aligns with your own? Are you a deep value Graham investor who completely trusts the math? Or are you a cautious Buffett investor who prioritizes safety above all else? I'll leave you to ponder that. Thanks so much for joining me on this explainer, and remember to always keep questioning the numbers.